we turned down fairly quickly on the 10-year. Have we put the highs in yields?
Yes, we have the highs on yields, Joe. I will repeat what I said to you last week. I think 4% is the peak. We have come down. We have come down a lot. But I don't think it is going to be a continued rally beyond, let's say, the 350 mark for the 10-year. The reason is that inflation is still a problem. I don't just look at long-term inflationary expectations or tip yields. I also look to see the latest inflation numbers, and last week, the Fed's preferred gauge was much more than anticipated. Most important for the Fed, if they back off now after having made monumental errors with the transitory inflation call during 2021, this is the last time they have to regain a little bit of credibility. So they would rather make a mistake in over-tightening rather than ease. And that is what is shown to you by the 2 to 10-year yield. Notice that while the 2-year yield and 10-year yield have both come down, the yield curve has remained inverted consistently since the beginning of July. That is giving a recession signal. It is also giving a signal that the Fed is going to keep tightening at least into the November meeting.
We'll come back to you, Sri, but let me get Anastasia to talk about this. A lot of times, I mean, I see what the UN is saying. It does affect lesser developed countries more when there's a global slowdown. And I don't know, does the Fed need to take that into account? Do central bankers need to take that into account? Anastasia?
Well, I think it's part of the equation, Joe, but I'm with Sri on this one, that I don't think the Fed is going to imminently pivot here because the job on inflation is far from done. And we got the CPI report that clearly stated that. We got the PCE report that confirmed that because the core inflation numbers still continue to move higher. So I think the Fed is not likely to step back from its current path. And, you know, the best case scenario is we get to 4% and they sort of slow down from there. But the challenge for equities, for example, Joe, is that with rates at 4%, that's a really high hurdle rate. And it kind of fundamentally changes a lot of things. It changes how people think about investing and saving and borrowing. And it just really puts this downward pressure on the economy. So what's really changed for equities is the relative value when you look at earnings yield minus the 10-year Treasury. It is not in favor of equities as it has been for the last 14 years. And then the second thing is when you tighten policy this much, I mean, hopefully nothing breaks, but it certainly is going to cause more of a slowdown, if not a recession. So that's what the equity investors really have to grapple with. But having said that, we had said such a big reset in the month of September, whether it's PE multiples coming down, whether it's technicals getting oversold, whether it's breadth just being washed out, that I do think that after this reset in September, we can actually be poised for better trading in October.
Okay, now I'll come back to you, Sri. So what is the Fed, what's the most likely course from here on out for the next couple of meetings, in your view?
At least in November, I'm looking still for 75 basis points. I think if you get favorable numbers elsewhere, for example, if you have job growth being very poor on Friday, which I don't anticipate, I think you're looking for about 225,000, in which case it cannot back off. So November is still 75 basis points. The question is really the December meeting, the last meeting of the year. And by then, we will have 2 more inflation numbers, 2 more jobs numbers that the Fed can take into account. So I'm going to say that I am wavering between 25 and 50 for the December meeting at this stage. Here is a key caveat. Going along with what Anastasia said before, I will go a step further. I think something is going to break. You have interest rates being increased at historically rapid pace. You also have quantitative tightening taking place at the very rapid pace. Keep in mind that the last time there was a 75 basis point increase before this year was November of 1994, not since. So if you have a combination of the two, that has never happened. And we don't know what will break. If there is a credit event, there is a financial institution that goes broke, then the Fed is going to pivot abruptly, and you're going to see interest rates come down, quantitative tightening switched over to quantitative easing in a manner comparable to what the Bank of England did. So that's the key caveat. If that doesn't happen by the end of the year, 75 in November, 25 to 50 in December.